Wonderful. So, Fred and Neil, it's all yours. The floor's yours, if I may say so.
Very good. Thank you very much.
Can I just check that the sound is coming through loud and clear?
Definitely. All cool.
Okay. Okay, great. I will hand over to Fred from Stifel to introduce himself, and then I will follow up after Fred.
Perfect. So thank you very much, everyone, for taking the time to dial in. I'm conscious it's been an interesting couple of days in capital markets. So there's plenty to talk about, and obviously this is for your benefit, so please do feel free to ask difficult questions, and that's what we're here for. My job is that I'm the Managing Director in the European Technology team at Stifel. I'm also in charge of UK public markets. So I was saying to Jean earlier that I actually wrote my dissertation at university on IPO pricing. So I try and make sure no one actually gets to read it, but that's my background. Setup wise, I've worked at various different firms and really looking mainly at small and mid-cap equity. I'm passionate about that, and I do think it's the fundamental bedrock of our European economies. Passing over to Neil.
And I'm Neil Shah. I am the Director of Research at Edison. Edison's an independent research and IR firm. We have been around for about 15 years, currently looking after about 80 companies in the TMT space. And a large part of what I do is get involved in public policy in terms of how we can improve European IPO markets. So very keen to engage in the topic of discussion today. If we come on to the sort of first slide, we can talk about the history of 2019, Fred, and it was a challenging year for a number of reasons in terms of IPO activity. Maybe you can touch on that.
So I think the difficult point from a capital markets perspective is that you look at the stats. In terms of issuances, 2019 was not a good year. And I think that's fundamentally to do with the way in which the funds are allocated, the way in which the setup works through, and also the way in which people have been looking at capital markets in recent times. I think where, though, there is an interesting point is that if you look at some of the opportunities that are starting to come through and some of the more successful companies, for a certain type of business, I think capital markets can be unrivaled in terms of the opportunity that it brings. And I think particularly for companies that have ambitions to be much larger businesses in the tech space that are born global, your ability to access a wider pool of capital is much higher. And what we are noticing as a US investment bank is actually there's a larger appetite coming from some of the US funds to actually invest in European equities than actually from the own domestic markets, which is something that, Neil, you've probably seen on your side as well.
Yeah, absolutely. And we'll touch on that later in the presentation. I mean, a couple of other things. 2019 from a UK-centric perspective was challenging because of Brexit, which caused a lot of uncertainty and closed the window for a lot of IPOs, followed by the election. That was then, once that was out the way, we felt that the window was opening. There's also a smaller pool of investors as a result of certain funds closing, the most high profile being the Woodford Fund, but also consolidation in the sector. So Miton and Premier getting together, which means there's a smaller group of people that you know we are respectively talking to. The IPO markets, you know, have struggled over the last couple of years, but there is a feeling that you know you should take a little bit of hope from the fact that you know deal activity has continued, particularly on the sort of secondary side. Fred, from your perspective.
Well, so I think there's a large number of companies that want to float. I think the problem with floating is, and we go on to talk about this, but floating is not an exit. Floating, if you're looking at an IPO versus trade sale, a trade sale ought to always win. And the difference is that if you're a founder and an entrepreneur and you're doing an IPO, effectively it's a liquidity event. So it's taking on equity to help your business grow, which is very different to effectively giving away the keys to the business. I think one of the things that people forget is that a lot of the very successful businesses have actually started off as small IPOs. I think the problem with an IPO versus a venture capital deal is you have to be a far higher quality business to go down the IPO route. So where IPOs come with a little bit of a health warning is if you don't see yourself as a business which has global potential or pretensions, then venture capital can be more attractive for that. At our firm, we do about 100 tech deals a year, of which approximately 60 are in the private markets and approximately 40 are in public. This year, the vast majority of those have been US-based public market deals. But what we are seeing is that, for high growth, technology businesses, we look at both debt and equity as a product from different points of view. Obviously, this is an equity talk, but we are of the firm opinion as a firm that equity is far preferable for high growth businesses than debt.
Yeah. One of the characteristics that we've seen within, certainly the London market is that we have seen this trend of de-equitization taking place. So the overall number of companies listed on the public markets has been declining. And behind this is, a trend that we've seen since the onset of the financial crisis, which is that you've seen a move into a low yield environment, which has meant that capital is being allocated effectively either into passives because the cost of exposure is lower, or it's chasing alternative asset classes, and including in this is real assets such as property, but also private equity, and the pool of money available to private equity has grown significantly over the last few years. And so we have actually seen a number of companies, or what we call retirements, take place. 2019 was particularly active in takeover terms. In the UK, sterling was relatively weak because of the Brexit uncertainty, and actually you saw quite a lot of, adding to Fred's point, of smart US money coming in and buying more structurally attractive businesses. The reason I think that's worth bearing this in mind is that it does contribute into an issue around liquidity. You've got the same funds effectively concentrated into a smaller number of companies.
Just picking Neil up on your liquidity point, just to give an example. So there's a company which I think you research, which is a small privileged account management cybersecurity business. I think your colleague Dan Rizdal researches it. And I mean, that went up 42% today on no news at all. And it's a small cap business. It's very interesting. It's very high tech. I actually was in a meeting with the US peer, which is a multi-billion market cap, very large company, and we done some research on both of them. And what was very interesting is the CEO and CFO were saying to me that with regards to product, there's us and some tiny company that no one's ever heard of, based just outside, in Reading, and it's not actually Reading, it's just outside there. So I think you know the company I'm talking about.
Yeah.
But the point is, from a equity investment point of view, your ability to get very high returns on these is very real. So the liquidity works both ways. I think also with regards to the replacement, acquired delisted companies, there are a series of businesses which in an ideal world would not have been acquired from a public markets point of view. So there's a company called StatPro, which those in the fund management industry will know very well. That's a company which effectively does data analysis for fund managers, looking at their portfolios, portfolio allocations. And the problem we've had is that because European equity technology valuations are, in my personal opinion, slightly artificially depressed, in line with both the weakening euro and weakening sterling, the ability for particularly US venture capital to buy these companies relatively cheaply has been higher. The flip side to that is that from an IPO point of view, a lot of money has been recycled back into these funds, which means they're going to have to look for the next generation of growth businesses to invest into.
And I mean, that's, I think, what bringing us in effectively to our conclusion, which is that while we have been looking at relatively sort of depressed IPO activity, there's a feeling that there is some optimism for 2020. The capital has been returned to investors, and we named some of the sort of takeovers, so StatPro within that list there. But also, some of the uncertainty was lifted at the end of 2019. The current environment is interesting in terms of a feeling that there is a lot of jitters in the market around the impact of coronavirus, but most companies that we're talking to, and certainly a lot of the sort of fund managers that we speak to, are going to be patient about this. I don't know what your sense is, but it's hard to do a deal at this particular moment in time. But for good quality businesses, where actually vast majority of the value is, in the longer term cycle, the current quarter matters less. So I think that the feeling is that this is a blip. That we are likely to sort of get back to a pickup in activity. We have a table here in terms of what does good look like, which this was produced to the end of 2019, I think, and it shows you the sort of top 20 IPOs over the last decade and their performance since IPO. Within some of these sort of qualify for EIS, VCT. Tax breaks. If you had to characterize, what makes a successful IPO, what would you say, Fred?
So I think, one of the things that I'm not sure that all of these companies have in common, but I know some of them have, is that they had good research written about them. So Neil's firm's obviously done a great job on some of those, and some of them are ones that I was involved with personally. Mm-hmm. So I won't necessarily mention those by name. But I think the key thing really is, what are you looking at the end of the day? If you're investing in these type of businesses, you're looking for pure growth. And the key point here is to not get lost too much in the financial metrics, because the reality is that if you do that, then you miss out on most of the top performers, certainly in this table, and I'll argue it across the market, not just in the technology sector. I think the other thing is that you're looking for a management team that can grow, and you're looking for a company that can access capital markets for the right reasons. So I would say that in my experience, the best deals, or the best IPOs to be specific, tend to be companies that need capital to help drive their business. They're ideally businesses that have technology, which means they're born global. And what I mean by that is their location is an accident of history, rather than the fact of design or their market. And also what they do is they use capital markets well. So I think you would find that pretty much every company on this table has used capital markets to help either do bolt-on acquisitions, hire new teams, new staff, new products. And really that's what equity capital markets are about, because if you can get a core group of high value, high quality institutional investors who have the ability to follow the money in size, you can then grow your business and use the capital to do it. So I think the one thing the best IPOs tend to have in common, in my experience, is it's the beginning of a process. And the way you should see it is an IPO is the end of the beginning, not the beginning of the end, and not actually an end in itself, but really a step into a bigger, wider world that you can leverage for the benefit of your business.
And I think we will spend a little bit of time helping people understand. So Fred mentioned that research helped a lot of these businesses get understood by investors. MiFID II came into effect at the beginning of January 2018. It has, in my view, created some issues in terms of how the market's functioning. Effectively, it's leading to a little bit of a breakdown between the sell side and the buy side. I think that Fred's firm, other firms do have very, very good connections effectively with institutional fund managers, whose job is to allocate capital. Where I think we can support in that is to, once these companies have come to market, is to socialize those stories to a much wider pool of capital, including, the liquidity providers, so the private wealth managers who will tend to buy in smaller unit sizes, retail get access to our research. So you often see, retail participation in these stories. And we will, of course, the narrative will help, institutional fund managers sort of understand the story, because we will continue following and put another sort of set of numbers in the market. So the key impact of MiFID II for us is, firstly, a restriction on discoverability of companies. So it is important that companies think about how they are telling their stories, and how they're going to access future investors, making sure that what they're doing is a significant when people are considering to invest right now. I think a recent CFA survey, the two biggest determinants in terms of whether someone is going to invest is, number one, liquidity, and number two, the availability of research to support investors in their due diligence. And research is a conduit to an access to a sort of broader pool of investors. I've talked already about the fact that there's less active money being managed, and more money going into passive. And I think that a real challenge in all of this is that how do you engage effectively with that sort of passive group of investors? What you need, I think the market, my view is that the market is changing to more akin to the sort of seed rounds that you're seeing in the private space. So even within the sort of public market, passive funds aren't necessarily sort of coming in to support IPOs. So it's important that you get the cornerstone institutional investors, get a story away, and then you can start to attract effectively these other flows of funds. We're also seeing fewer research analysts. I think the chart's been inverted here.
Can I make a comment on this? Because
Yeah.
I mean, I'm obviously in the investment banking side, so we have an independent research arm where under MiFID II we can only distribute our research to certain specific investors.
Mm-hmm.
I think one of the things that is often misunderstood is research effectively as a company is your portal to demonstrate what you can do and how you can do it. And I think particularly for smaller businesses, the value of research is not to be underestimated, because the reality is there are a huge number of companies where the price is just wrong in the market. Mm-hmm. And actually that's often because people haven't done the work on them. And if you look at the number of companies where you can make 30 or 40% without doing anything particularly clever, but actually buy something quite quickly for the short term, you ought not to be able to do that in an efficient market. And I think, people talk about efficient market hypothesis. I think the markets are efficient, but they're efficient in the long term. And in the smaller and mid-cap world, that's particularly important, understanding that you need the product of research to effectively leverage your ability to demonstrate that. Yeah, and I apologize, but the chart hasn't come through, but there is, it's not just the number of analysts. Where that research is being distributed is also important. And what you are seeing is that the relationship between particularly the tier 2 and tier 3 funds who can't afford to pay for bulge bracket research, etc. They are starting to rely on firms like us who can provide them with research. So the current sentiment that I would say is that there is a tendency for companies wanting to stay private for longer, and I would capture that in the short term, the nature of the public markets, the short-term nature of the public markets, the volatility that you're currently seeing, compliance burden, these are all things that companies cite as to one of the reasons that they are thinking about sort of staying private longer.
Interestingly, I did a panel last week with a mixture of private and public investors, and I guess one of the points that the sort of listed company fund manager is making is that we have not seen a proper downturn for a period of time. I think we've been insulated for that, and the beauty of public capital is that you've got access to pools of capital that fund managers can deploy to you, where you can sort of pick up distressed assets, things relatively cheaply. So providing you've got the right sort of cornerstone shareholders who can support you, I think there's a sort of feeling that equity markets themselves are going to start coming back into vogue, particularly if you start to see private equity unable to offload, some of what they've been invested in over the last year, and you start to see shades of that over the case of the back end of 2019. So that I would summarise that what is the current environment, and where are we with the IPO markets? It's challenging, but we do think that the market will come back. What are the things that we hear from fund managers when they're looking for companies? A very clear and differentiated strategy. So you're doing something which other people aren't doing. A growth path. So the ability to scale from where you are. So Fred's point about this is the start of a journey. I think institutional fund managers quite like management teams still to have some skin in the game, and you've got to balance that out with liquidity criteria. So, enough offer holding that the sort of management team, are seen to be incentivized and to be driving the business, but not so much that it deters from the liquidity of the stock. And this is a UK sort of centric comment. It was notable from the sort of table that we presented earlier that there are some certain attributes. The UK is particularly good at supporting buy and build strategies, but perhaps less good at supporting secular growth stories. US investors are particularly good at supporting secular growth stories. And when we look through that list of top 20 performing IPOs, all but one of them was actually represented by a single broker. And I think that the relationship between a bank and its institution, where they take accountability, is noted by institutional investors. Often where you're getting syndicates, pricing deals, etc., there's very little left on the table. You're probably going to see those IPOs sort of struggle to deliver returns for investors, and investors know that is the case. With that, I think we will hand over back to the team and open up for Q&A.
Does anybody have questions? If so, you please put them in writing.
Well, if I can you hear me? I'm Vittoria from ES Business School. Welcome to everybody to the webinar. I would like to have your opinion about one of the recommendations that we presented in our report in Paris, and soon the report will be released. So I will just now present the recommendation. So government should sponsor paid for research on tech SMEs. So we thought about the fact that tech companies should be encouraged and supported to produce quality research. So support at an European level could take the form of a grant covering no more than 50% of the cost. At a member state level, this could take the form of cooperation, tax relief. So what do you think about this? What's your opinion about this recommendation that we drafted after the study we conducted in the last months?
Okay, so I don't know if you've seen the Phase A 2020 IPO report, but sort of similar recommendations were in that report. They thought that a pan-European portal for research, which was funded in part, was certainly one of the recommendations to improve sort of research coverage. They cited the sort of stock exchange examples in Hungary and Germany as examples of successful models where that's happened. So there is support provided to the SMEs for the sort of provision of research. In terms of the impact of those schemes, they have been shown to be very successful in terms of stimulating liquidity and making companies more attractive from an investment perspective. We work on the German scale sector or scale scheme. So this is the high growth segment for the Deutsche Börse, covering about 50 companies on the scale segment on a sort of similar kind of arrangement. And I think that the feedback we've had is that it's led to more liquidity than they've previously seen. It's led to more international investors investing in those German companies than they've previously seen. So I would say that the examples of where it's happened, it's been done successfully. I agree that it should be a balance between some funding, but the company is also committing to providing some of the funding to avoid a kind of free rider problem. We think it's important that they engage in the process and committing some of the costs to it. And then feedback we had from the companies themselves in terms of the funding proposals was that the grants and tax relief are useful, but they tend to be collected at sort of in arrears, whereas actually support for some of that sort of funding cost up front would be more helpful.
Thank you very much for your answer. Thank you.
Thanks, Victoria.
Okay. If we have no other questions, I suggest that, I just have thank you to say to everybody, and particularly to Neil and Fred, and see you next week for the next webinar. Thank you. Goodbye.
Thank you.
Thank you.